So today's video is going to be talking about gold and specifically looking at sort of the historical trends over the last 10 years, what has happened to the price of gold, sort of breaking down whether or not gold should be a part of your portfolio as of 2017, and also looking at sort of the potential trends over the next 6 to 12 months and where gold might go price-wise. And we're going to start off by looking at sort of the historical trends over the last 10 years and analyzing what happened during different key economic events to the price of gold. Now, traditionally, gold is considered a very safe and secure investment. It is often in your portfolio as an investor to hedge against a number of different things. It protects against things like economic downturns, currency devaluations, inflation. It's one of those very resilient investments that protects against a number of different things. And that's typically why people own gold. So, what we're going to start off with is right in 2007, and as you probably know, one of the first key events we're going to come across is the 2008 mortgage crisis. That is when sort of the almost entire world's economy was sent into a tailspin because of the real estate bubble that popped, and all of that debt and all of the issues that arose around that. Now, an important thing to note in this situation is the price of gold fell as the economy fell as well, and that's something you'll see. The value of gold will go down during these economic downturns. Reason for that? Well, when you're struggling to keep a company going, when you're struggling to make ends meet, gold doesn't really help with that. It's an investment that's secure, but it doesn't sort of save your company. It will follow sort of the same trends when it comes to the issues with the economy. Typically, you won't see as significant. It's less volatile in that it will fall, but not to the same degrees. But the really key thing about gold, and the reason it is resilient in a market downturn, is that when an equity market's falling, companies are going under, companies are going bankrupt, debt is being defaulted on, investments are almost disappearing into thin air, and that you lose all of your money. Even though the price of gold falls during these economic downturns, gold is gold. Gold is incredibly resilient. Your gold bar doesn't default. It doesn't disappear. It doesn't go bankrupt. It might fall in value, but it doesn't go away. And that's the key thing about gold. Gold's value will typically fall during a recession, during a market crash, but it does not go away. You will still have that gold in 5, 10 years unless you choose to sell it. And so it may go down in price, but eventually it returns. And that's why it's resilient during these market crashes. Typically, say during the 2008 market crash, there is another investment that is known as bonds that is actually pretty resilient in these same situations. Another investment that you choose if you want to protect against market crashes. A bond is typically, or is an investment where you give money to a company or an organization, and after a set number of years they agree to return that amount of money, and during those years they agree to pay you a fixed interest rate. And the key thing about bonds, and what makes them good as an investment during these market crashes, is that fixed interest rate. So, for example, let's say that you lend $1,000 to a company and they agree to 8% on that every single year until they pay back that $1,000. Well, if you got that in 2007 and then the market's crashed, well, what happens when the market crashes is that as the economy slows down, as companies struggle, as growth falls, governments start to pump money into the economy to try and restart it. What does that do? Well, that lowers interest rates. And so bonds at the 2008, at the height of the recession, might only offer, say, 3%. And, well, if your bond's offering 10% and currently everything's offering 3%, the value of your bond goes up. So another resilient investment in these types is bonds, because you can actually make money during recessions. You can make money off bonds during these market lows. Key thing is, though, when you're lending money to someone, and this is really what sets it apart from gold, is that the company you're lending to can go bankrupt. You can lose everything if that company does go under. That's the key difference, and that plays a huge part in today and why bonds are not as strong as they were as an option during the 2008 crisis. But those are sort of the two most resilient investments when it comes to that. And the reason I want to highlight both is those are sort of your two main options when it comes to an investor as your sort of safety investments, as your things that hedge against the bad things that can happen in the economy, gold and bonds. And I'll break down at the end of the video why I personally think gold is a significantly better option right now. So, as we come out of the 2008 crisis, you'll see that gold prices rose, and they rose pretty significantly. Now, an important thing to note that sort of I mentioned before is during crashes, gold prices will fall. During rises, when the market recovers, gold prices will typically rise as well. The key thing to note about this is a bubble. This is an outlier and something that you will not typically see with gold prices. What happened after 2008 is there was a lot of sort of insecurity still about the economy as it recovered. There was a lot of worry that it might fall back into a recession, that more issues might arise that send the economy back to sort of those lows. And so a lot of people were looking for safe investment options, and gold is one of those options, so people were buying gold. What this created, though, is more and more people start to look at gold, and they saw this rise in price and went, wow, that's pretty fantastic. I can make a lot of money by investing in gold. And while there were very valid reasons to invest in gold, more and more investors sort of started to jump on this train, this almost hype train of gold, and it continued to push the prices higher. More and more people were like, well, I want to make money, so I should jump on this train as well. And it continued to push prices well beyond what was sort of considered a reasonable amount for what gold was offering when it comes to protection. And this is what happens when you create market bubbles. You see this, or you saw this rather, with oil prices when they reached $200 a barrel. There was a lot of hype pushing that price way higher than it realistically should have. You can see that in today's day and age when it comes to cryptocurrencies. Cryptocurrencies have increased by massive amounts over the past 2 years. There are very valid reasons to own cryptocurrencies, to hedge against currency issues, but not at the values they're at right now, not at the price tag they're at right now. And what happens with bubbles, when it pushes prices up like this, eventually they pop. And that's what you see happen in 2013. Gold almost reached a $2,000 high, and then it fell back down to about $1,200. And again, the really key thing I want to highlight here is this is unrealistic for gold prices. This is an outlier. This is a blip. You should not expect to see gold prices rise that dramatically after a recession. That's not a typical sort of thing that happens. This is an outlier. So if you ever expect to see gold skyrocket from, say, $800 to $2,000, don't. That's not realistic. This is one of those rare sort of situations that doesn't follow the typical trends. That's a really key thing to understand. But typically, you'll see gold prices sort of pseudo-mirror almost the equity market, in that when it falls, gold will fall. When it rises, gold rises. 2013, we sort of had a return to sanity. The bubble popped almost, and gold prices fell pretty significantly. And since then, we've almost had a pretty consistent sort of price level for gold up until around 2017. Now, over the last couple of months, gold has actually started to rise a little bit again. And there's this very specific reason for that. And as you've probably seen on the news and just sort of everything going on in the world right now, there's a lot of uncertainty. There's a lot of potential for problems when it comes to economic instability. There's a lot of issues with the current American government situation when it comes to their currency and their economy. The issues in Europe right now with Brexit, with all of the social issues, are pretty massive. There's issues with Russia, with North Korea. There's a lot of uncertainty, a lot of instability. And gold is an investment that is very secure and resilient. And that is why gold is starting to rise in price again, because it protects against a lot of these issues that people see right now out there in the world. So it's been rising a little bit over the past couple of months. Now, sort of getting to the meat and potatoes of the video, where is gold going to go over the next 6 to 12 months? Well, there's more or less 4 options for it. It can either fall significantly, rise significantly. There's maybe 5 options actually. It can rise modestly, fall modestly, or it can stay the same. So let's break down sort of the percentages or the likelihood of each of those options happening. Is it going to fall significantly over the next 6 to 12 months? No, almost certainly not. You will not see a massive drop-off in the price of gold. It's very, very unlikely. There is a modest potential for it to slowly fall back in price, but that's also highly unlikely. The most likely options for the price of gold over the next 6 to 12 months are that it's either going to stay the same or that it's going to gradually increase in value. And it's highly unlikely it's going to take off, especially like it did in 2011 period. So the two most likely options for the price of gold is it's either going to stay the same and sort of keep on almost a sort of a straight line, or that it's going to gradually increase in value. Those are the two most likely options, with the gradually increasing value probably the most likely. Reason for that uncertainty that's been pushing gold's price up over the last 2 months, there's no easy answer for any of those issues. There's no easy answer for North Korea. There's no easy answer for what's happening with Russia, in the United States, in Europe. And so those problems aren't going away. The sort of demand for gold is not going to go away either. So you're not likely to see sort of any decline in the price of gold. So those are the most two likely options. Now, should you have gold in your portfolio? Is that a good idea? Almost certainly yes. As I mentioned before, there's more or less two options you can have, two main options as an investor for safety investments in your investment portfolio. One is gold and one is bonds. And bonds, well, in the past were a very good option, right now are kind of worthless. And they're worthless for two reasons. The first is bonds have an interest rate associated with them. So you get paid a certain amount in return for lending to an organization. Well, after 2008, when the economy fell off massively, governments threw a lot of money into the economy in an attempt to restart it, an attempt to sort of push economic growth back. They haven't stopped since 2008, to date. And as such, there's a ton of money in the economy right now. They have more or less constantly been pushing money into the economy to keep it going, to keep growth going. And what happens is that when you're pumping all this money in the economy, why would a company go to, say, you or me to borrow money from you? There's no point. They're not going to give you interest for that. They don't have to offer you the 6, 7%. They can offer you 1 or 2% because there's so much money in the economy right now. So the interest rates with bonds are pretty much worthless right now. They've fallen off the face of the earth. And as such, that makes them a pretty poor investment option unless the economy falls off the face of the earth. And then you have that increase in value. The second major issue that I sort of touched on a little bit before is what can happen when an economy goes through a recession is that a bond is a good option in that it can increase in value as long as the company or organization that is buying that, offering that bond, doesn't go bankrupt, as long as they don't go under. The issue is 2008 did not solve the problems that caused 2008. Sort of the aftermath, the consequences and the moves taken by the government did not fix the problems. All they did is really reset it and pushed them off. What does that mean? Well, the next recession, when it does come, the next sort of collapse of the economy will probably be worse than 2008, and it will probably be longer than 2008. So what that means is the same bonds that from companies that did not go under in 2008, they're probably going to be at a lot bigger risk of going bankrupt now because governments are in a worse position to deal with sort of economic consequences. So bonds have worse interest rates and they're less secure in the sense that companies are more likely to go bankrupt. So gold is considerably better right now as an investment option to protect against the issues in the economy. Now, should your portfolio be all gold? Almost certainly not. Realistically, gold should represent a small to medium-sized portion of your portfolio. If you're anywhere, say, between 5 to 25, 30%. 30% being if you're a very conservative investor, realistically 10 to 15 is probably a more reasonable amount. It's great right now. You're not going to see a massive amount of money. If you're looking to make a lot of money, gold is not the option for you. But it is a very safe investment right now. It is a very secure investment right now that will probably net you modest returns over the next 6 to 12 months. So hopefully this video has helped sort of break down where gold's at right now, where it's likely to go over the short term, and sort of what the advantages are of gold to have in your portfolio. As always, if you like the video, very much appreciate like, share, and subscribe. It helps the channel grow, and have a great day.